Thank you, Nvidia. The market rallies this morning, 30 minutes until the start of your cash equity trade. I'm Dani Burger.
And I'm Aoifinn, and Bloomberg Open Interest starts right now.
Coming up, Nvidia crushes it. A bullish forecast fuels bets that the AI rally still have legs. Kevin Warsh gears up for Jackson Hole, his debut with bond markets on edge. And dollar store chains offer a diverging view of a retail sector that's coming under pressure. It's the stock to watch today. It's Nvidia with a quarterly revenue more than doubling to $96 billion, topping Wall Street estimates. Its crucial data center business also beat expectations. And Nvidia says that momentum will continue until at least 2028, targeting 70% sales growth for the next year. The expectation was something around 44%. CEO Jensen Huang says the company is going to work with its supply chain to increase demand beyond the 70% metric. They said it could be closer to 100% were it not for the supply constraints. Joining us now is Bloomberg Tech host Ed Ludlow from San Francisco. Ed, I mean, these numbers are huge. They're really hard to wrap your brain around. Can you just put into context what 70% means for this company?
Well, it's astonishing to have a number at all. Nvidia does not do this. They don't give that sort of full-year fiscal guidance or look that far ahead. So you're right how you framed it. 70% is top-line growth based on what they know they can get their hands on in terms of supply. You know, memory is still the bottleneck, both from a pricing pressure standpoint and an availability standpoint. And the appeal that Jensen Huang and CFO Colette Kress, when I spoke to her on the phone, made was, we wish we had more supply. We wish. We'll do anything we can to get it. But the memory chip makers have already allocated all of it for that same period. So demand is running at 100% growth. It's doubling. But 70% represents what they think is achievable in terms of shipping accelerated computing systems. There is an impact on margins, right? They will raise prices. And you know, you said at the top, they crushed it. With respect, the stock fell, right, when the numbers for 2Q came out and the guide for 3Q came out, because it's exactly what everyone expected. The shocker was in the fiscal 28 guide.
And Ed, as you said, there were some weak spots when it comes to margins, which they do expect to bottom out soon. But there's also the competition creep, right? That others like Amazon and Google are developing their own chips. What did they have to say about that? How did they address it?
A second big moment during the call was an expanded deal with Amazon AWS. Millions more GPUs, the use of CPUs, and that probably also gave some upside in the after-hours performance on the shares. And the irony of that is that Jensen Huang was asked about the Frontier Labs doing custom silicon in the context of the circular financing concern that's there, because Nvidia also invests in those Frontier Labs. And what Jensen Huang said was twofold. One, his biggest regret was he hasn't invested more money in the Frontier Labs and that he didn't do it sooner, especially with 2 IPOs on the horizon. But second, that he has high conviction that Nvidia's technology is better, the economics is better, and it was fighting talk, right? But basically, his expectation is that those Frontier Labs, even if they're working on their own chips, will be using Nvidia tech for running their AI for years to come. And in other interviews and media reports, he's kind of dismissed the threat of custom silicon right now. But yeah, this growth forecast would indicate that competition or different options in the market for accelerators is not stunting Nvidia's growth, at least.
Ed, there was a report from The Information this morning that Nvidia is buying Hugging Face. And I wonder what we should make of the sort of investments in the ecosystem and the ways that Nvidia is branching out.
So the Information report says that Nvidia's agreed to do this just below $13 billion. There had been many other media reports that Hugging Face was looking at M&A or acquisition opportunities, including with Nvidia. Hugging Face is a platform that gives developers access to a huge library of open models to get access to the models, use on top of the models. And Nvidia is very committed to open models and to an open ecosystem. Nvidia has its own library of open source models that span everything from LLMs to world models for AI, etc. So it kind of makes sense, but none of this is official. Nvidia said nothing, Hugging Face has said nothing, and curiously, Hugging Face are coming on the show later to talk about a robot that looks like an ice skating duck. So maybe we will get the opportunity to ask about it.
I can't wait. Ed, just really quickly, did you read OpenAI's post today about the Hugging Face hack?
Yes, and again, what they underscore is human error.
Yeah.
We've interviewed Hugging Face at length, other third parties. The ability of those models to get access to the internet and escape the sandbox environment is still being put down to human error and the rules that OpenAI had in place.
Yeah, they essentially let them do it. Ed, I'm so excited for many reasons on Bloomberg Tech to your coverage of Nvidia and that interview. That is Ed Ludlow, Bloomberg Tech at 11 a.m. And don't miss his interview with the Hugging Face co-founder Thomas Wolfe. I guess on their singing, skating, duck-inspired robot, but much more, as Ed was alluding to. We've also got another wave of earnings to get through. Earnings from retailers. Best Buy shares, they are falling dramatically despite a raised outlook. Also, the Dollar General soaring on a boost to sales guidance. Dollar Tree disappoints after a huge rally since May. Let's discuss with Bloomberg Global Managing Editor Craig Trudell. Craig, thinking about how Dollar Tree and Dollar General position themselves, Dollar Tree tries to kind of say we're more urban, we're for everyday people, where Dollar General maybe is more, I don't know, more geared towards, I know they're both lower end consumers, but maybe Dollar Tree's more geared, Dollar General's more geared that way. How should we sort of dissect their differing fortunes?
Yeah, I think consumables and food for Dollar General is a distinguishing factor. I think also just greater market presence and number of stores. But this is a clear case of one outperforming the other, and when you have such a close peer, even in the name, and you have a case where one is raising their outlook, the other is standing pat, you're going to see a sort of market reaction along these lines.
And Craig, we keep on hearing about a selective consumer, and that's why I thought Best Buy was really interesting, because people are buying computers now, they're buying phones, they're also splurging on AI glasses. I don't know if you have AI glasses on right now, or trading cards apparently. So what does this tell us about where the consumer is in this cycle, what they're willing to spend on?
I'm hanging tight for now with the AI glasses, but with Best Buy, it's very interesting. A strong second quarter. Initially, the stock rose on the higher outlook for the year. That being said, sort of implied within that raised outlook is actually that there will be a bit of a slowdown from what was a strong second quarter for them. That's, I think, something that kind of maybe helps explain why the stock is reacting it is. I think one of the other things that has come up on the earnings call that if it's not wrapped yet, it's about to, is just the issue of memory chips, which Ed just spoke about. That's an issue, of course, for some of their key products. And potentially, some concerns about the sort of durability of the strong results that they had in this past quarter.
Yeah, I don't know if you watch F1, but what I just thought of is if you watch with Sky, they have this feature where you can pick which driver you see their point of view. And now I feel like you're pitching a new idea that we wear the Meta glasses so you can watch the show from Craig's point of view. I would certainly sign up to that. So Craig, here we are. We've gotten the bulk, if not all, basically, of the retail earnings. What's your read on the season been?
I think there's a lot of concern about the second half of the year, and sort of understandably so. We've seen some of these retailers consistently talk about tariff refunds and some noise about just how much of a boost from the latest results were coming from that, and whether that can continue. The state of the consumer, the pressure on the consumer, particularly in the form of fuel prices. I think also diesel, sort of, and that flowing through in terms of input costs for a lot of these retailers. For a company like Walmart to have such a rough quarter. After such a sustained run of steady growth, does sort of ring alarm bells if you're looking at the state of the retail
Walmart
sector.
Looming large over all of these results. Craig, thank you so much for joining us. Great to have you, Craig Trudell from the Bloomberg News team. Fed Chair Kevin Warsh will be taking center stage tomorrow. Investors looking for clues on where rates will go from here. Will he give those clues? Kansas City Fed President Jeff Schmid says that policy isn't in restrictive territory. He spoke with Bloomberg's Michael McKee.
The last Q3, Q4 data for me last year was, I thought we certainly weren't restrictive and maybe even a little accommodative. So we've got work to do.
Michael McKee, Bloomberg's international economics and policy correspondent, joins us now from Jackson Hole. And Mike, it should be outlined that what this that this Jackson Hole is supposed to be about is something like the future of finance and a conversation on stablecoin. I'm going to guess we are expecting much more from Chair Kevin Warsh than just that.
Yeah, there's kind of two issues hanging over this conference, and one is, what does Kevin Warsh say? Will he or won't he give Wall Street what it wants in terms of some kind of reaction function? But we don't know. And I asked Jeff Schmid. He said he hasn't let him know either. So that's going to be something that is going to be weighing on everyone here and, of course, everyone on Wall Street until 10 a.m. Wall Street time on Friday. The other thing, of course, is Lisa Cook. She filed her response to the administration last night, and everybody's waiting to see how the president reacts.
All right, Mike, thank you very much. Looking forward to the rest of your coverage. That's Bloomberg's Michael McKeon. Tune in to our Bloomberg Surveillance Jackson Hole special tomorrow, where we'll be jump beating to the chair's keynote address. Coverage begins at 9 a.m. New York. It looks like a green screen, doesn't it?
It's so beautiful, Dani, with the Tetons in the background. I mean, we got to go.
I know, we do got to go. It doesn't look real. I think, if anything, to prove that it is indeed real and not a green screen behind Michael McKee, I can assure you it is indeed real. Let's get a check on your markets this morning. 20 minutes to play for until your trading day begins. We are looking at a rally, and it's no surprise that tech is outperforming, with the Nasdaq up 1%. Thanks to Nvidia putting up huge numbers. A viewer wrote in to tell me, with every percent gain of Nvidia, that will be adding $25 billion in market cap to this equity index. 10-year yields, those are higher, though, up by about 1.5 basis points, tracking the move in Brent crude as that goes higher by 0.8%. Let's look at some of the individual movers this morning. With that is Nora Melinda. Good morning, Nora.
Good morning. A few stocks I'm monitoring this morning. First up, software stocks getting a nice boost this morning, and that's thanks to Salesforce and CrowdStrike. Salesforce giving a stronger growth outlook and expanding its partnership with Anthropic. CrowdStrike, though, also delivering a strong forecast as demand for cybersecurity keeps growing. You're seeing shares of both names higher in the pre-market trade. Now, sticking with cybersecurity, Okta raising its outlook for the second time this year. That's as companies spend even more money to secure their new AI systems. And its backlog for subscriptions also hit a record. Catch CEO Todd McKinnon on Open Interest next hour. And finally, it looks like Wendy's takeover may actually be off the menu, at least for now. Reuters reporting Nelson Peltz Tryon has no plans to make a takeover bid at this time. You'll remember Wendy's already pulled its outlook and cut its dividend earlier this month. That all as it works on a turnaround. Shares of Wendy's down double digits, falling by about 13%. Those are your morning movers. Dani?
Nora, thank you very much. Coming up here, Ferragu from New Street Research says Nvidia is on track for a $1 trillion revenue run rate in 2028. He's going to be joining us next. This is Bloomberg.
Now to high interest, a look at what's making headlines around the world. Shein raising $1.7 billion after pricing its IPO in Hong Kong. Sources telling Bloomberg that would value the fast fashion retailer at just above $26 billion, a downgrade from the $100 billion price tag it commanded 4 years ago. Trading is expected to start September 1st. The U.S. government is investigating Singapore-based Apex Logistics for its suspected role in smuggling Nvidia chips to China. Sources telling Bloomberg authorities are looking into whether Apex violated U.S. export restrictions by transporting AI systems made by Supermicro, which contain Nvidia chips. Speaking of, shares of Nvidia are rising in the pre-market. The chip maker beating earnings expectations and delivering a very bullish sales forecast, fueling bets that the AI rally still has legs. Nvidia expecting revenue to grow 70% in 2028, well above Wall Street estimates. Dani.
Yeah, let's talk more about that, because New Street Research Global Head of Tech Infrastructure, Pierre Ferragu, has increased his 2027 earnings forecast for Nvidia following their results, saying that Nvidia has a strong hand with performance ecosystem, fragmenting market and financing power. Pleased to say that Pierre joins us on set. Good to see you. Thanks for stopping by. What do you do with that number? 70%. Not only do they usually not give that sort of guidance, but giving such a large guidance that itself was supply constrained.
This is like beyond what you could have ever imagined, right? And so what do I do with it? I analyze it, and it's in a supply-constrained environment. So that means this 70% is going to be reached quarter after quarter. So if you break it down, it's 15% growth every quarter from like the kind of $110 billion they guided for the next quarter. That means at the end of next year, they will be on a run rate of making $1 trillion of annualized revenues. That's a big take. This is actually something Jensen hints towards back in March at GTC when he talked about the $1 trillion orders he got in so far on the Rubin and Blackwell systems.
But given the stellar results, is there anything that was cautious to you, whether it was the merger, the margins, the competition, anything bring to you any caution to circular financing that they had to address when it comes to this name?
Well, so I think the guide they gave is supply constrained. We follow the whole supply chain. We look very closely at who's deploying what. We do think demand is significantly above that. So the things that could keep me nervous would be supply issues. And one of the things we discussed last night with management was, this like mounting feud against data centers in the US. People like feeling uncomfortable with these giant data centers popping up in their communities. So that's one of my concerns. And then on the supply chain, I would actually say so far, if you look at the track record of the supply chain, at actually pushing the limit a bit further every quarter, I do think we have very good chances that at the end of the day, Nvidia beats that 70% guide. Because remember, it's supply constraints. And when you look at your supply over the next 12 months, you're usually on the cautious side. So I wouldn't be surprised to see a tiny bit more growth next year.
And when Colette Kress was speaking to you all on the call, and she was talking about the financing that they were doing, she said the majority of that is going to fixing this, is going to the supply chain. Does that alleviate some of the concerns about circular financing if the goal of the financing is to help the supply chain and thus get that 70% look more like 100%?
That's a very, very good question, Dani. And it alleviates some concerns, but not these concerns, because the reality is that people who want to invest in this data center, they're like standing in line and waiting for it. And you have all the hyperscalers, they have trillions of dollars they can invest in these data centers. But it's actually alleviating the concern of Nvidia, who doesn't want to see people deploying compute depending on hyperscalers who are also developing their own chips. So Nvidia says, come to me, invest in a data center with our technology, and don't you worry about financing. We have you covered. Look at our balance sheet. Very, very smart and a very good way to protect their ecosystem.
And speaking of the hyperscalers, when they're obviously projecting 70% growth next year, does this mean that they're expanding beyond the hyperscalers to other areas?
Yes, but not that much, actually. Hyperscaler CapEx are still growing very, very fast. We do expect hyperscalers to actually burn free cash flow next year, like something around $100 billion, because their CapEx is probably going to approach $1 trillion. But at the same time, this financing headed towards what we call the neo-cloud, so these like smaller, very agile teams who can like pull together power, shell, and land very fast together, are actually representing a growing part of the market. They were maybe, they are now like approaching more than 50% of the market, and so the hyperscalers are slowly coming down in the mix.
One of the other interesting facets of this ecosystem is just the price of using AI is collapsing. I mean, you get these new models coming to market, and we don't know where they've come from, and they're performing nearly as well as the LLMs, and they're free, if not something close to free. Is there a necessary tension in the idea that the product itself, that is models and AI, is becoming very cheap, but the cost of building the ecosystem is still very expensive with the supply constraints?
Yes, it's a very good question. And so all this is very new, but just think about a product you know very well, your iPhone. Your iPhone has increased more than 2x in prices over the last 15 years, right? Now, the cost of one transistor on the chip of your iPhone has come down by a 10,000x over that period. But you're having 1 million more transistors on your iPhone than you had 15 years ago. So the token is the new transistor. Price per token will keep coming down like very, very rapidly, even faster than the transistor. But the amount of tokens you're using, there is no limit. And like Elon Musk likes to put it, there is no limit to the demand for intelligence. And as long as intelligence can deliver value, like growth in the number of tokens will always exceed the pace at which the cost
I'm
per
guessing
token
this
is
is why
coming
Jensen
down.
Huang wants open source modeling so much, because it just means more people can adopt it.
More people can adopt it, and open source means you're a smaller organization. You can't develop your own chip, and he likes that.
Pierre, this has been so fantastic. Thank you so much for coming in. What an earnings report. Pierre Ferragu of New Street Research. Coming up next hour, we're going to continue to discuss Nvidia growth, sustainability with shareholder and wealth manager Brooke May from Evans May Wealth. You're watching Bloomberg Open Interest. Five minutes until your opening bell. Here's how things are shaping up. We are up 0.9%. It's all Nvidia. I wish we could show you the Nvidia pre-market price right now, because it is up pretty dramatically at this moment before the opening bell. There you go. We are up 6.7%. The magic of TV. That is what is supporting this market at the moment, even though yields are moving higher. Now that we have Nvidia out of the way, the other risk event to contend with will be Jackson Hole tomorrow morning in a chair from Kevin Warsh. Less than 4 minutes until your opening bell. We are going to begin the trading day with Moneta's Aoifinn Devitt as Nvidia helps to lead this market higher. Can it be the driving force? Can we continue from here? All of that and more coming up after this break. You're watching Bloomberg Open Interest. Let's get your trading day started. You are watching Bloomberg Open Interest. I am Dani Burger alongside Yahira Arnand and Matt Miller, still off. We are looking at an S&P and a NASDAQ, which is being aided by a rally of more than 6%, at least in the pre-market of Nvidia. We'll see how those shares shape up at the open. The Dow, that is still down. Small caps under pressure this morning with higher yields. Over down at the New York Stock Exchange, we have Amplify. They are celebrating 10 years of their ETFs and the launch of the top 10 ETFs. I was looking at their top 10. It looked like there are only 8 companies in it. I must have been misreading that, because it'd be weird to be a top 10 ETF and just have 8 companies. Down at the NASDAQ, Green Plains celebrating 20 years as a listed company. They supply biofuels. They've outperformed so far this year, but they're down if you look at the past 5 years. So that's the deal with them. I promised I'd show it to you. Let's look at it. It is Nvidia. Here's how we stand at the open, up 6.5%. Every percentage point added for this company is $25 billion in market cap. So their earnings solid. Quarterly revenue more than doubling to $96 billion. That tops Wall Street estimates. Data center business also beat expectations. But to be clear, when it reported that, the stock fell. Instead, it gets on an earnings call and says momentum is going to continue in our fiscal year of 2028, and we will see 70% sales growth for the next year, a figure they have never given out. They usually only give quarterly guides. And not only that, it was supply constrained. They said it would be 100% had they not had supply issues. Let's discuss this with Moneta Global Wealth Managing Director Aoifinn Devitt. Aoifinn, what did you make of that? 70%, a huge number from this company.
It is a huge number. We are in a world of huge numbers right now. Certainly SpaceX kicked it off, and Anthropic is playing in on it with its 30 trillion revenue estimate that it threw out there yesterday, just as it primes the pump for its own IPO. So these numbers are really extraordinary. Clearly, they are codependent, as they spoke about their relationship with their customers, particularly OpenAI. They spoke about their projections for that to be one of the most significant technology companies in history. So clearly, there is a lot of rising tide here that's affecting those numbers. And I suppose it's important to remember that Nvidia has really lagged many of the top line names for the most of the year. So this is really probably just them catching up on a bit of some sort of settling of the momentum around that name.
As you said, Moneta, Aoifinn, that they have been needing to catch up with the other chip players, and there have just been overall a lot of concerns over the AI trade, whether it's the sustainability of the spending, the circular nature of it. You even had Sam Altman over the weekend talking about adoption being slower than he had expected. Is this a defining moment, NVIDIA's results being able to project this far out such stellar sales?
It's a great point as to whether this is a defining moment. I'd suggest that we're not at that kind of point yet to be able to definitively say that. I think what's very interesting is there was a previous guest speaking about some of the anti-data center momentum. The slipping of demand is critical. When a number like 30 trillion comes out, I think it's important to remember that the entire retail food spend in the world is 8 or close to 9 trillion. So are we really going to be in a scenario where we're spending 3 times the amount on AI as we are on food at a global level? I think those kind of numbers start to really bring into focus what kind of demand are we extrapolating. Abundant, infinite intelligence is great, but to what end? And there will be a share of wallet that comes into bear. There will be a trading down into open models, as we've already seen. And there will be a productivity focus as to what exactly is all this expenditure leading to. And the fact that bondholders and consumers and investors are becoming more likely to scrutinize was really seen in the hyperscalers having to pay up when they issued their debt. It seems inevitable they will slip into negative cash flow. So what do we then do? Do investors fund to infinity, or do they start to really pick and choose? And that picking and choosing is what I think will be a definitive moment.
Aoifinn, I'm so happy you bring this up, and I'm also very happy that you bring up the figures that we've been getting from Anthropic. Look, it's all well and good for a private company to slowly leak out numbers, basically having the media do the work of their roadshow for them, of putting up things like $30 trillion. How important is it to have this company actually be public and be reporting numbers that are some sort of standard, that are not just them cherry picking numbers that make themselves sound good? What does that mean to this market when Anthropic finally is public?
That's a great point. And I think we understand now why there has been a delay with some of these IPOs. There is a sense like, are these numbers rigorous enough for scrutiny as a public company? And we know just about how much probability is built into this. The demand pattern is moving wildly from enterprise to consumer, and also this cost, as we know, is moving wildly. Some of this is that the uncertainty is being shored up essentially by the kind of financing that Nvidia is providing, but we're not in a clear picture. So will this be at the moment when they finally have to come clean if they do go public? Yes and no. I'd say if we look at the SpaceX as an example, there's quite a lot that's speculative still built in there. And investors knew it, and the media knew it, and the bankers knew it. So I'd suggest we're still going to be in a similar dance there of having some things that are certain and some that are really probabilistic.
Aoifinn, and Nvidia's putting a bow on what's been a very strong earnings season. But now that earnings are essentially behind us and we don't get that steady drip of strong results, is this going to become more of a macro-driven market? And how are elevated yields now going to play into the picture?
That's a great point. I'd say memories are short, particularly in the kind of cycles we're seeing today. There will be some focus on what Kevin Warsh says, how he stakes his claim to have a voice in this narrative, which is becoming increasingly crowded with bondholders themselves, with the Secretary of the Treasury. Everyone seems to want to weigh in on where the bond market should be. I think the weakness in the bond market underscores a real concern there. Geopolitics haven't gone away. We're coming into winter where the demand for fuel is going to be more acute. And we're coming into the midterms, and we're going to have an affordability focus everywhere. When consumers are reminded about just how unaffordable some of their day-to-day lives have become, they'll start to really cut back and maybe think about that planning ahead. So I don't expect a fantastic retail season towards the end of the year, as I think there will be much more focus on pricing. So earnings will be a lift, yes, but not for very long.
The theme of this Jackson Hole is financial innovation, implications for payments and policy. Aoifinn, how much of a revolt will there be in this market if we don't get something more from Kevin Warsh, if he doesn't do something to lay out a framework, try to clean up the issues, the problems from his July presser?
Well, it's going to be a delicate, as I said, parsing of every word. I suggest now that the narrative that he's on the back foot because he hasn't got out of the gates, essentially, with winning the hearts and minds of the markets and the bond investors, that's going to be some pressure. His personality is what it is. He's not prone to having the same extravagant, perhaps, discussions and telegraphing that were in place before. So there will be a focus on him. It's too early for him to right any ship. I think we know at the Fed that their reputation is built very slowly. It was clawed back after losing a lot of respect when they did miss the inflation timing. So I'd say it's clawed back slowly. It isn't going to be completely lost, but investors will perhaps give the benefit of the doubt, but he's not going to, in one speech, put all minds at ease.
Again, tomorrow morning, we'll hear from the man himself. Aoifinn, thank you so much for joining. Great to see you. That's Moneta's Aoifinn Devitt. And we are about 8 minutes into your trading day, so let's get a check on this equity market. We are up about 0.25%. The breath ain't good. We're only seeing 152 stocks moving to the upside, and that's just going to be because of these big numbers that Nvidia is posting. Aoifinn put it really well. We are in the land, the time of big numbers. So with a 6.3% gain, Nvidia is lifting this index by 36 points. The index itself is only up 17 points. In other words, if it were not for Nvidia, we would not be looking at a positive benchmark right now. The entirety of ecosystem rides the tailwinds of it. Broadcom, that is up. CrowdStrike and Salesforce, they have their own strong earnings, so they also move higher by 14 and 16% respectively. On the downside, it's everything else in the tech universe. The hyperscalers and big cap tech are down. Apple, Amazon, Microsoft, Alphabet, Meta having a not so good day. Looking at the individual sectors, it's really only tech that's lifting us up. Info tech up 1 3/4%. Everything else is down. A lot of the safety type indexes are down. Utility staples, consumer, comms, materials, all of those are heading lower. But again, because of Nvidia, we are up 0.25%. So yes, coming up, we'll talk more about it. Nvidia lifting the entirety of the tech sector. Margins, they are expected to settle next year. More on Nvidia coming up. This is Bloomberg. Minutes in your trading day. Here's how markets are shaping up. It is an AI ecosystem supported thanks to Nvidia's earnings. We are up 0.7% on the Nasdaq, outperforming the S&P. Semis also having a good day as Brent crude, that does continue to rise. It is just below $89 a barrel. Let's get you some top calls here. With that is Nora Melinda. Hey, Nora.
Hey, Dani. First up, Citi downgrading Abercrombie to neutral, but that's not because it didn't like the quarter. The firm actually called the results, quote, impressive. After yesterday's more than 30% rally, Citi thinks that the stock's gotten too expensive. Shares of Abercrombie down by about 0.8%. Turning to software, Barclays boosting its price target on Salesforce to $276. The firm says growth is starting to speed up again, and the latest earnings suggest continued momentum. Shares of that company up about 17%. And finally, Nvidia giving Wall Street a lot to like. The company says revenue could grow about 70% next year. Wall Street was just expecting about 45%. JP Morgan raising its price target on the stock to $320. And it's far from alone, with a whole list of firms boosting their targets this morning as well. Shares higher by about 7% in this morning trade. Those are your top calls. Dani?
Nora, thank you very much. We'll catch up with you in the next hour. Let's stay with Nvidia and bring in Bloomberg equity reporter Carmen Reinecke. Carmen, we're used to Nvidia putting up really large numbers. We're just speaking with Aoifinn Devitt, who's like, we're in the era of large numbers. So sometimes it's hard to fully wrap your head around 70% revenue for Nvidia. Just how big of a barn burner was that for them?
It's a complete barn burner, and it's crazy to see the reaction in the stock, especially because going into the report, the sentiment was very muted. It was not really expected that there would be this kind of upside after, especially given the last 5 earnings reports, and it had fallen 5 out of 6 times after reporting really solid earnings. So this 70% figure was so important. It's exactly what the market wanted to hear, and we're seeing the stock react, in kind today. It's up 7% right now. I'm looking on my screen, more than 7%. This is more than $350 billion in market value coming rushing back into Nvidia here. And it really is sort of reinvigorated some of the momentum that we were losing in the AI trade and kind of, calming fears about the potential of a bubble.
So that 70% number, where is it coming from? Are they expanding beyond the hyperscalers? What are the reasons for that huge amount of growth next year?
That's such a good question. And yeah, I think what they're seeing is that there's growth beyond the hyperscalers. They're seeing more business coming from other parts of the market, and just seeing that total AI ecosystem expand. That's really important. I think the other thing that's really incredible here is that that figure is actually conservative. They said if they had more sort of supply, if they had more access to certain components or supply, that could be even higher. So hugely bullish forecast, and that's for next year, right? Because it's the fiscal 2028. We're currently in fiscal 27.
Carmen, can you kind of just describe where we were up to this point after the sell-off of July and just what the bar was for Nvidia, how important it was for them to come out and give this market some sort of reassurance?
Yeah, they're definitely still looked at as like the kingmaker of AI. Jensen's views and sort of what the company says going forward are so important. And there was a lot of concern. I think the hyperscalers gave very mixed earnings. You know, investors weren't seeing the ROI from everyone that they wanted to. And so Nvidia coming forward and saying that, you know, we're still seeing demand, things are, you know, gangbusters are going really well was very important. And we'd lost a lot of momentum in the AI trade, as you said. And outside of the semiconductors, there was a little bit more green on the screen in some of the other parts of the trade. Like, for example, some of the memory names jumped last night and are up a little bit today. So that's like SanDisk, Micron, stocks like that.
They did point to some weak spots, whether it's the competition coming from the hyperscalers, the likes of Google and Amazon with their own chips, also the margins. But why do you think that wasn't enough of a dent, right? And that we're seeing the shares pop so much this morning?
I think some of it was that they had come in a little bit. You know, they're still off highs. And, you know, the margins are such an interesting point because 70% is still so high, right? And I think that the market, you know, investors really are digesting this and they're realizing, like, okay, maybe it's not as high as they have been, but this is a really incredible gross margin figure. And so we think this is okay. Like, we can stomach that kind of gross margin. We can stomach a 70% gross margin if revenue is growing at this rate.
It does feel so silly to look at 70 plus and be like, that's not enough. That's not enough. We want to see more from you. For going forward for Nvidia, how much of a constraint is just the politics of it all? Is their ability to continue to spend and have data centers be built that benefit this ecosystem?
You know, it's such a good question, especially because this report really kind of calmed fears about circular financing, which has been such a huge thing and was really important going into the report. It's going to be really interesting to see. Obviously, the political sentiment is so important. And I'm going to be really watching to see if it actually leads investors to be making different decisions. It seems like so far it hasn't really crept into where like Wall Street is putting their money, but you know, that remains to be seen. What happens in the
Carmen,
future.
thank you so much for joining us. Great to have you on. That's Bloomberg's Carmen Reignited. Coming up, another part of tech that is performing exceptionally well this morning. Software stocks are rising after strong results from both Salesforce and CrowdStrike. We have that for you next. This is Open Interest. "20 minutes into your trading day, and we move higher. Outperformance in tech thanks to Nvidia, which is making up the bulk of this market's performance this morning. Nasdaq up 0.75%. Russell 2000 doesn't have that add of an AI boost and also is feeling the pressure from 10-year yields this morning, which are moving higher only by 1 basis point. Tomorrow morning, Jackson Hole, around this time, we're going to be gearing up to hear from Chair Warsh. How will that change things? What will he tell us? Gold, that follows, have been rallying thanks to enthusiasm over debasement trade. This morning, as I mentioned, Nvidia adding hundreds of billions of dollars in market cap this morning. Some earnings to get through. Dollar General does well. Dollar Tree does not do well. It is smaller than Dollar General. They were able to capture more sales, have more grocery aspects to their stores too. And then there were Salesforce and CrowdStrike. Look at the performance of these companies. They reported earnings. Huge enthusiasm. Salesforce, their ties with Anthropic. Let's get more with our tech reporter, Ryan Vlastelica. Ryan, these are companies that at the start of the year were left for dead over a scare of what AI would do to software. Let's start with Salesforce. What was so strong and what has the street so confident about them this morning?
Well, it's really twofold here. They gave a very strong forecast, and they also announced an expanded partnership with Anthropic, which is helping investors sort of believe that this is going to be a company that, rather than facing some kind of AI-related disruption, maybe it's going to be able to really harness some AI tailwinds and really see an acceleration in growth going forward. This has been a company that, like you said, has repeatedly sold off this year. A lot of concerns about its ability to navigate the AI era. This report is really helping to sort of reverse the sort of bearish sentiment surrounding the company and helping the company to sort of make the case that it's going to be a winner in the AI age.
And Mark Benioff started the call saying that the SaaS apocalypse, that we need to stop talking about that. But can we, Ryan? Can we really stop talking about it given the software earnings that we've gotten this quarter?
Well, not to make an obvious point here, but I do think it is going to be a case-by-case basis. Just earlier this week, we had results from Intuit, which is the tax preparation software company, and those results were weak. We did see people come out and say, I think this is maybe a sign that people are going instead to some of these free AI services rather than using this legacy provider or paying up for these legacy services. So that was a really sort of cautious signal to start us off on this week, which, like you said, completely got reversed last night with Salesforce, with CrowdStrike, with Okta, some of these other companies that are really saying, no, our results, at least in the near term, look pretty enduring and resilient.
Ryan, how the way that we interact with these software companies changing, whether it be Okta and their offering to agents, whether it be Salesforce and their agent force, their AI tool, when you don't necessarily have people logging on to these various software platforms, instead, various agents are being created that constantly are pinging them. Just how much is the business model changing in real time?
I think these companies are doing a lot of adapting and evolving right now. Like you said, there are some real changes here. And the real question is, do these companies offer something that is sort of like a durable moat? Or is it something that can be replicated by some AI service? Now, we have seen some companies like Adobe, like Intuit. These are ones where it feels like the competitive case for them is a lot weaker just because you can imagine sort of AI alternatives coming in and taking some of their lunch. However, Salesforces and other companies like that maybe rely on proprietary data or have more stricter compliance issues surrounding their usage, these are ones that we feel like if they can integrate some AI services into their functions, if they can offer their own AI-related products of their own, maybe that makes the case for people continuing to use them, continuing to pay up for them, and helping to sort of insulate their growth potential even as they face sort of increased competition from AI native companies like Anthropic, like OpenAI, and of course, like you saw, Salesforce is partnering with Anthropic, so maybe that kind of removes that threat a little bit.
And building on that, Ryan, we are seeing the cybersecurity stocks you mentioned, Okta and CrowdStrike soaring this morning. And these stocks have already had really strong runs. I'm seeing Okta was already up 55% this year. CrowdStrike up more than 60%. So the bar was high and they cleared it. Do investors just increasingly see this as the place to be, cybersecurity?
Yeah, this is something we've written about several times throughout the year, especially following the release of Mythos, the Anthropic AI model, which there was a lot of concern about. This thing is so powerful that it really does raise threat risk associated with using it. If hackers are using these kinds of AI services, for nefarious means, and that really does increase the demand for cybersecurity services, which is why we've seen this part of the software market has really been strong this year. It's really been able to avoid a lot of the weakness that has otherwise been seen in, say, the software as a service names.
Hey, Ryan. Thank you very much for joining us this morning. Bloomberg's Ryan Vlastelica. And again, these companies adapting in real time to the environment we find ourselves in. This market rewarding that adapting. We are seeing gains in the teens for both Salesforce and CrowdStrike. Meanwhile, Nvidia continues to be the pillar of this market, up nearly 7%, a huge company adding huge numbers after a huge estimate for what they see of next year's 70% growth. That means that, again, there you see Nvidia up almost 7% as the NASDAQ outperforms. Coming up, we're going to continue this conversation. Brooke May on the staying power of this rally. Yahaira mentioned it. Okta, also a huge gain in today's market after they reported earnings. We're going to speak to the CEO Todd McKinnon after they raised their full year forecast and what it means to be a cybersecurity offering in this environment. Plus, we have Jackson Hole to discuss all of that coming up. Bloomberg Open Interest, Hour 2 starts after this break. We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I am Dani Burger alongside Yahaira Anand, and it is a market that is rallying thanks to Nvidia. Coming up, we discuss just that. Nvidia's bullish sales forecast fuels bets that the AI rally still has legs. Kevin Warsh gearing up for his Jackson Hole debut with bond markets on edge. And the U.S. raises the stakes with Canada, floating a ban on some Canadian goods. We begin with our top story this morning, the AI boom showing no signs of slowing. Nvidia CFO says broader demand is fueling a global infrastructure build-out and another year of massive growth.
The surge in AI demand is driving a global infrastructure build-out, supported by an expanding and diverse set of growth opportunities, spanning hyperscalers, AI labs, AI natives, enterprises, and sovereign customers. We expect to grow revenue by approximately 70% in fiscal 2028.
Let's discuss all this with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. Mandeep, I'd love to just get what your initial reaction was when you saw that 70% revenue estimate for next fiscal year.
I mean, going into earnings, we were hearing how hyperscaler capex would have another big year in 2027, and we had soft guidance from companies who gave some color. But last night, when they raised that forecast to 70%, and which is almost, $100 billion in excess of what the consensus number was, that sort of confirms that next year hyperscale capex would be north of, 1.3 to 1.4 trillion. And a lot of that increased estimate, half of that is going towards Nvidia, which is what their hyperscale exposure is. They have about 50% exposure. To my mind, it's a combination of SpaceX, NeoCloud, and the hyperscale capex upside that we have seen in the numbers, and that's what's trickling down to Nvidia's forecast.
And so, Mandeep, does this signal that it is going beyond the hyperscalers, and what does it mean that it, doesn't have enough supply to keep up with the demand that it's been seeing?
Yeah, so I think one thing was very clear from Jensen last night is he's pushing the entire supply chain to really ramp up capacity, and obviously he feels the demand is much higher than that 70% guide they gave, but there's no doubt that he's pushing all his suppliers to add more capacity so that they can service the demand they have. And look, in terms of memory prices, he talked about, how they're absorbing some of the costs and not passing everything. And that is what kind of led to some gross margin compression and the guide of 72 to 73%.
Now, Mandeep, you bring up a great point. It's something that John was talking about this morning on surveillance that I would love to ask you. Does that mean that 70% figure, was that for Wall Street? Or was it for the suppliers? Was it for the memory chip makers?
I think he just wants to be transparent about how they are working through the supply chain. Obviously, the supply commitments went almost 160 billion plus in this guide. So last quarter it was around 119 billion. This quarter it was close to 260 plus. So that's what goes to show that he wants to commit to all his suppliers so that they feel comfortable to expand capacity. And everyone fears about the eventual slowdown and the lack of utilization down the line. But at this point of time, he's willing to commit the capital he has in terms of making sure the suppliers feel comfortable expanding capacity.
And they also talked about some of the competition that they're seeing from the likes of Google and Amazon and even OpenAI with its Jalapeno chip. What do you make of that, Mandeep? And did they do enough to ease concerns for you?
Well, it's all in the guide, right? So if the hyperscale capex is going up and, the numbers will be around 1.3 to 1.4 trillion, and Nvidia is getting their 50% share, then that's what goes to show that ASICs aren't really taking share, although it is a growing pie. So I think every company could do well here, but they're not going to be at the scale of Nvidia, and that's why they're able to maintain their share as this capex grows.
Mandeep, great to hear from you. Thank you so much for joining us. Mandeep Singh from Bloomberg Intelligence. Joining us now to continue the conversation is Evans May Wealth Managing Partner Brooke May, who is herself an Nvidia shareholder. So I'm sure you are enjoying the day today so far, Brooke. How important was it to get Nvidia not only have strong results, but get the kind of market reaction that we're seeing this morning?
As goes Nvidia, goes the market. And we're clearly seeing that today. Their forecast and guidance was incredible. I think that we were really surprised by the potential for such strong revenue growth. For a company this size to continue to grow at this pace is phenomenal. And to see them expanding beyond the hyperscalers, offering their services to a much wider base is the way to go right now to continue to see the revenue growth that we've seen historically.
Hi, Brooke. We've seen so many things hanging over this AI trade, what we saw over the summer during that sell-off, whether, all this spending is sustainable, the circular nature of it. Do you think that Nvidia did enough to ease concerns around that and that this could take the market higher at this point?
I definitely think that they're easing concerns somewhat. But I do think that the circular financing and some of the other lending should be monitored. I don't think that there's an overextension right now because demand is there. When you listen to earnings calls, 46% of companies indicated that they're seeing AI efficiencies. That's really just scratching the surface. These companies haven't gone all in, and we're only seeing half of companies indicate that they're seeing the efficiencies. So there's tremendous demand out there. And we think that, the loans that Nvidia has agreed to back up to 25% being issued by this new consortium of big investment firms, KKR, Goldman, Blackstone, BlackRock, we're going to see with that demand, the need for capital. These neoclouds can't cash flow like the hyperscalers can. And so for Nvidia to be able to step in and backstop those loans, they believe that there's enough of a residual value in a secondary market for those chips that there isn't a big risk in making these loans.
Brooke, so if we're finally starting to see in the numbers for this earnings season show up of AI efficiencies, of corporates actually adopting this stuff and seeing some sort of profitability gain or at least margin compression from it, where are you seeing that? Now that we look through this earnings season, who are the benefiters of AI?
Really, it's broad and it's trickling down now. It's not just the hyperscalers that are seeing benefits. When we look at corporate margins were almost 17% this quarter. That's phenomenal. And when we look at the earnings growth, earnings growth is up 50% year over year. You factor out Amazon, Alphabet, we're still seeing earnings growth for this quarter at more than 30%. So that's a broadening, and companies are seeing these efficiencies. Therefore, they're going to continue to invest if they're getting the return on capital.
And Brooke, how much is the margin story a factor for you when it comes to Nvidia? They pointed out that margins will be lower this year. Obviously, any company would be thrilled to have the margins that Nvidia has. But what does it also mean for the rest of the supply chain when it comes to the memory names and things like that?
Yeah, moving from 75% margin to 72 to 73% isn't anything to snub your nose at. Still very, very strong. And I think that says that there's pricing power out there. And it says to the suppliers, the demand is there. The demand is going to continue to be there. Continue to invest in your infrastructure so you can supply us with what we need to be able to meet the demand of our customers.
Well, we've gotten through this risk event, and it's a positive one for this market. We're starting to price in that 70%. Brooke, to what degree will we have done that by the end of today and now need to worry about the next risk event, which is Jackson Hole tomorrow, hearing from Kevin Warsh? Just how big of an impact might this have on markets based on what he says or doesn't say?
Yeah, all eyes will be on Jackson Hole, shift from Nvidia to Jackson Hole. And I think that we're not going to know too much more than we know today. He's indicated that he's not going to be as transparent as Powell was in his statements. And I think he's going to be focused more on the broader economy and AI and what that could mean.
And so what does that mean for this market, Brooke? I made the point earlier that with earnings season largely behind us, and yes, it was a great earnings season, of course. But looking forward, we have tomorrow's risk event of Kevin Warsh. But looking forward, is this becoming a more, macro-driven market? And so does that mean more choppiness from here?
Yeah, September, October tend to be the most volatile months in the market. So we are setting the expectation, especially with this being a midterm election year. But at the end of the day, the market is going to trade off a multiple of earnings, and earnings are strong. We don't think that we'll see, the earnings growth that we've seen this quarter. However, we're expecting double-digit earnings growth in the foreseeable future, and that bodes well for the market. It's not just large caps either. We're seeing really strong momentum in small cap, international, and just recently we've seen Bitcoin and gold participate. So it really is a good time to be an investor, and you can have a broad, diversified portfolio as opposed to just being concentrated in large mega cap Mag 7 companies.
Is the recent participation, though, of gold and Bitcoin healthy, Brooke, if it's based on renewed concerns about the dollar and a debasement trade?
Yeah, it's a it's a give and take. So clearly, that rally is in response to concerns. So I think that it's something that we have to keep an eye on. We're seeing right now a little bit of a conflict between the Treasury and the Fed, and what's going to happen with rates and inflation. And so debasement is a concern. But gold, Bitcoin, that's a way to diversify portfolios. It's a non-correlated asset class that can actually reduce risk over time.
Hey, Brooke, really great to catch up with you. What a day. What a week. Brooke May of Evans May. Well, thank you so much. And the week, it ain't over yet. We also have to get through Jackson Hole, as Brooke was speaking about, a speech from Chair Warsh and what that might bring. In the meantime, yields are moving higher by 1 basis point for your 10-year yield. NASDAQ stays afloat, more than that, up nearly 1%, as Nvidia gains 7% this morning. Let's take a look at some of the other movers on our radar this morning. With that is Nora. Hey, Nora.
Hey, Dani. First up, the dollar stores, though I'm not exactly sure how much is actually a dollar anymore. Dollar Tree sticking with its sales outlook after a huge rally since May. Investors, though, left underwhelmed. And Dollar General, meanwhile, raising its outlook after a better quarter. Shares of Dollar Tree pointing lower, while Dollar General is higher by about 7%. Now, sticking with retail, Best Buy seeing stronger demand for computers, phones, and TVs. And that's even after lifting its outlook. But a lot of the profit boost came from tariff refunds, and those just won't repeat. And that's what investors are focused on today. Shares of Best Buy lower by about 3.7%. And finally, Burlington. Now, that's a store that you could get lost in. Sales didn't quite live up to expectations, and the company's putting $55 million in tariff refunds back into the business. Shares of Burlington pointing lower by 2.2%. Those are your morning movers. Dani?
Nora, thank you very much. Coming up, Jamieson Greer injects another threat into the trade dispute between Washington and Ottawa. We'll have that for you next. This is Open Interest.
Now to high interest, a look at what's making headlines around the world. New York City is facing another round of thunderstorms and even the slight chance of a tornado. Flood watches starting midday will cover New York City's 5 boroughs as well as parts of New Jersey and eastern Pennsylvania. The National Weather Service saying it could rain up to 2.5 inches per hour. Gotta run home after the show. AI platform Hugging Face unveiling a duck-inspired robot that can be taught tricks. A video demo of the robot named Micro Duck shows that it can roller skate, carry small objects such as socks, and sing alongside other micro ducks. It costs $400 and is set to go on sale later this year. Catch Hugging Face co-founder Thomas Wolfe on Bloomberg Tech at 11:30 a.m. New York time. And U.S. Trade Representative Jamieson Greer suggesting that the U.S. should consider banning some Canadian goods. In an interview on Canadian television, Greer also indicated that talks with Canada's trade representative remain on hold, saying we don't have open channels right now. Dani?
Yeah, Hyra, let's continue that conversation. Joining us now from Washington is Bloomberg Washington correspondent Tyler Kendall. Tyler, what is the latest between the two nations?
Well, Dani, at this point, the threats just keep coming. The USTR Jamieson Greer saying that the U.S. would consider banning certain Canadian imports. We didn't get much info beyond that, though, of course, that would mark a significant escalation. The context that we have to keep in mind here is that the White House's own view at this point is that their latest wave of tariffs levied under Section 338 over allegations that Canada is discriminating against U.S. commerce are tied to the fact that, in part, some Canadian provinces have already banned the sale of certain U.S. alcohol. So they already sort of feel like this trade tension is continuing. But regardless of the threat at this point, it doesn't feel like we're moving in the right direction, including after last week we heard from both sides that they were nearing this deal. But as you just mentioned there, the USTR said that he currently doesn't have any open paths of communication with his Canadian counterpart, though our own reporting does indicate that the two sides never truly lose contact, and they both have initiative to try to get a deal done. I'd point you to a new analysis by Bloomberg News that finds that states that President Trump won in 2024 are expected to be impacted twice as much as states that his Democratic opponent, then candidate and Vice President Kamala Harris, won. That includes in states like Ohio and Michigan, Michigan, two places that are actually in the top 5 of Canada's export markets. Those two places have two very closely watched Senate races that could ultimately decide the balance of power in Congress. And Dani, at this point, both sides are digging in despite what could be this political pressure on both sides to get something done. I'd say that the USTR went on in that interview to defend the U.S.'s negotiating posture, saying that the U.S. was forthright throughout that auto levies in particular would not extend to all vehicles, as that remains probably the top sticking point between the two countries.
And Tyler, Politico is reporting that the administration is considering sweeping new tariffs on semiconductors on a day when we're talking about Nvidia and all the demand of this AI build-out. How significant of a threat could this be to the U.S. data center build-out and this idea that the U.S. wants to dominate this space?
It could be a significant threat, Yahaira, considering that the reporting does say that these tariffs have the potential to be not just sweeping across advanced semiconductors, but also potentially apply to those downstream products that use them as components. Now, we should say that this is a threat that the White House has long lobbied against the industry and has consistently said that relief could be offered if those companies do ramp up their domestic production and investment. The Politico story does say that one of the ideas under consideration would be that companies would be allowed to import tariff-free under a certain quota that corresponds to how much domestic investment there ultimately is. We should say the broader context here is that the U.S. does already have a very limited tariff under Section 232, those national security concerns against certain advanced semiconductors that aren't destined to be used in the U.S. but end up stopping off here as part of the supply chain. So this would be a pretty broad escalation, if you will, on behalf of the administration that has been trying to bolster domestic production. At the same time, though, we have long heard from the industry, not that they're against building up the domestic supply chain, but that this takes time and money, and especially amid the competition to try to ramp up the AI build-out, they caution that tariffing the most essential supply for that could ultimately put the U.S. behind.
Tyler, it's also a president that is in the midst of helping candidates in the midterm elections. As you know, he will be in Texas with Ken Paxton. How is the data center conversation playing out there?
It's actually dominating the conversation, Dani, and this is a historically competitive race, considering that we know that this has been a seat that has been reliably red. But at this point, recent polling, including from the University of Texas, actually has Ken Paxton, the attorney general there, behind his Democratic challenger, James Tallarico. It's not just in the polling, it is also in the money. Cash on hand for June shows that Paxton had about $2 million on hand compared to Tallarico's $21 million. And we've really seen the data center issue emerge as a make or break one in this election. We saw Tallarico, the Democratic contender, put out early and talk often about what he would do in regard to data centers. He had a rather robust plan, if you will, outlining some of the different permit provisions that would need to get done. On Monday, we had Paxton put out his plan supporting Texas Governor Greg Abbott's bid to essentially halt permits until that they can do a further review on electricity consumption and how water would be impacted. This is an issue that is difficult for both sides of the aisle. I spoke yesterday to the Utah Governor, Spencer Cox, on Balance of Power, who said that this is illustrating voter frustrations, not necessarily about the affordability concerns, the environmental concerns, but just writ large, how Americans are perhaps a little bit cautious when it comes to how AI can impact their lives going forward. But, Dani, I will say President Trump walks a very fine line on this. He wants to help consumers as he puts forward his ratepayer protection pledge, but he also maintains the U.S. has to stay ahead in order to compete with China.
Hey, Tyler, thank you so much for your coverage. Really interesting stuff. Tyler Kendall in Washington, D.C. Still ahead, we're going to be speaking with the Okta CEO Todd McKinnon on the company's outlook and the growing push to secure AI agents. This is Bloomberg Open Interest. Nearly an hour into your trading day, this equity index is at the highs of the morning, with the S&P up 0.5%, the NASDAQ up more than 1%. Russell 2000 having a hard time hanging in there as yields continue to chart higher. Is that a lens into what the rest of this week looks like when we get past Nvidia earnings, and then attention turns to Jackson Hole. So there you go. Your 10-year yield's up nearly 2 basis points. Brent crude is also climbing this morning. Look at Nvidia, up 7.2%. It is remarkable to look at the world's biggest company have moves to this degree after a huge estimate for what revenue next year will look like. Micron down 1%. Diverging fortunes between the Dollar Tree and the Dollar General. Remember, Dollar General has more stores, it has more groceries, so they are different business models slightly, even though they're catering towards a value consumer. A good day for software companies. Salesforce, strong results, a partnership with Anthropic helps, and CrowdStrike, the demand for cybersecurity is strong. They're up 18%. And speaking of which, we're going to have more on that in just a moment. Okta shares, look at what they're doing, jumping after boosting its forecast. We're going to be speaking with the CEO on the other side of this break. This is Bloomberg. Okta shares are surging after a beat and a raised quarter. The cybersecurity company is betting on security for the growing number of AI agents inside businesses. Joining us now is the co-founder and CEO, Todd McKinnon. Todd, I guess we got to get used to a world where the numbers are just big, whether it be the rally in your stock, another upgrade for your revenue view. What's driving that growth? What's behind the numbers?
Well, I think everyone is seeing what we've seen for a long time, which we think in the next decade, identity management can be the biggest category in cybersecurity. Today, cybersecurity is about a $200 billion market. Biggest category in there is network security. Over the next decade, we think it'll be identity. And so I think everyone's realizing that. Our customers surely realize it, and they're thinking about securing their identities, but also how they incorporate AI agents and how they secure that. And it's driving a great Q2 across the board for us.
Todd, just on that, can you help explain and lay out what that world looks like? Because in the olden days, the days of yore, it would be one person, one identity, using your software. Now it has changed where people are using multiple agents to get tasks done. What changes when you no longer are catering towards an individual person, but instead a multitude of agents per person?
Well, I think over the last few years, the industry has gone through a couple waves. The first wave was, oh my goodness, look how powerful these chat bots are. That was 3 or 4 years ago. And then 2 years ago, it was, everyone is going to build agents, and these agents can be autonomous. They can take long-running actions. They can automate new things. They can make decisions on their own. Everyone's very excited about this. Now what people are seeing is that you need a way to secure and manage these things. You see new cyber breaches where these agents kind of break out and take over and do bad things. And everyone's realizing that we have to control and we have to manage these things. We were working on one deal last quarter where we started the POC with the customer showing our products, and they had 50 agents. And 2 weeks later, they used our products again to detect that they had 1,500 agents. So these things are everywhere. Every software company is saying they have agents, and people are building their own agents. And we're in this wave now where customers are realizing that they have to invest to manage and secure them, because as you said, they are like a human identity, but they're much more powerful and much more broad in what they can do, but that brings risks as well that we can help control.
Hi, Todd. So is that the biggest risk that you're hearing about from CEOs and CIOs, or is that there's something else creeping, lurking in the background that we're not aware of?
Well, I think most CEOs and boards they're managing the risk and they're thinking about the risk, but they're actually more optimistic about what these things can do for their business. And we're actually moving from a phase where I'd say most of the energy around agents was automating processes and getting companies more efficient and controlling costs, to a wave now where they're actually thinking, hey, how can we actually build new products? How can we actually create new offerings that raise the top line? So that's a really interesting dynamic as well. It's one thing to fund an initiative for a company when they're trying to cut costs or be more automated. It's a whole other thing when they're investing to grow their top line and grow their business and take market share from their competitors. That's a really dynamic budget environment, and we're happy to help them do that.
Todd, just looking at some of your competitors, Palo Alto bought CyberArk. They looked at Okta at one point for a possible acquisition. As some of your competitors grow bigger, do you feel the need to do the same? Would you look at M&A too?
Well, I think it gets back to that fundamental difference in philosophy we have. We believe strongly that we've been focused on identity management for 17 years. I started the company 17 years ago. I was focused on identity management before it was ever cool. And I think now everyone's realizing that in the next decade, it's going to be the biggest category in cyber. But different companies have different strategies. Most companies in securities, they're going to try to do everything in cyber. They're going to try to do network and endpoint, and they're going to try to do cloud security, and they're going to try to do security logging and security operations. We're very clear. We're focused on identity and what's happening with the importance of identity security and how critical it is to companies and how critical it is to securing AI and AI agents. We think it's the right strategy, and that's why we're tripling down on our products. We're the only company that has this array of products across every subcategory of identity.
Todd, does
no one
that
else
also,
has it, and we have the focus.
Apologies for interrupting, but does that also mean that you don't like the idea of being an acquisition target, that you like the idea of remaining standalone versus joining one of the bigger players?
We think that the opportunity is huge. And in terms of going after that opportunity, we're looking at making Okta the most valuable thing we can in the world. And that's what we're focused on. And I think it's working. If you see the focus, the products are great. We're taking market share. We're helping our customers be successful. And we're very happy with that strategy.
And Todd, as open weight AI models become more capable and even more widely used, does that make the attack surface significantly bigger? Is that something that your customers are looking at and looking to you to protect them from?
It's a very important point you raise. There's many facets of this technology. And when companies are trying to think, how do I automate my business? How do I create new products? They're going to get technology from everyone. They're going to get technology from different model providers. There's different frontier models, as you mentioned. There's different open source models that have amazing efficiency and amazing capability. There's different development platforms. There's different applications. There's new applications. And the core challenge is how do they stitch it all together? And that's where something like Okta really has an advantage, because we're not tied to any one model. We're not tied to any one infrastructure. We're not tied to any one security stack. We'll let the customer stitch it all together and build the right capabilities and deploy the right capabilities for them. And that neutrality is really resonating. You look at our business this quarter, 30% of our bookings, one of our best bookings quarters ever, was from new products. And these are new products that work with everything. They work with CrowdStrike, they work with Palo Alto Networks, they work with Microsoft, they work with Anthropic, on and on and on. And that choice and flexibility is really resonating in the market.
Todd, could I just take a giant step back away from the company itself? I would love to get your view, just because you are on the front lines of this. You understand what these companies are doing, how they're creating agents, how the agents are going out there into the world and gathering information. There's been this big discussion of what happens when this gets to its next logical conclusion, when there are more agents in the world, for example, than humans. I saw some discussion basically saying they're going to be the ones that create culture because there's more of them than there are people. Where do you think we are heading towards? How do you kind of see this future as we continue to agentify everything?
I think it's not necessarily about the number of agents, it's about how connected they are. I think the most important thing in this wave of technology is you have to connect the systems. And it's something in our industry we haven't done a great job of. If you go into most organizations, the systems are often still in silos. The HR team doesn't know what the finance team is doing, doesn't know what the manufacturing, and a lot of it is manual work and kind of drudgery, stitching it all together. And the thing about agents that you have to do is you have to give them more information. And the potential and the power of that is really exciting. But the risk is also bigger as well. When you connect more information sources to one agent, you really have to manage the connections to it. You really have to manage what it can do. You really have to manage the unforeseen risks. And that's the balance. You want to connect it to the most information, but also be able to control and manage it. And that's kind of the Goldilocks middle that we're all trying to strike.
Interesting, Todd. Thank you so much for joining. Really appreciate your time this morning. That's the Okta CEO, Todd McKinnon. Let's get a check on your markets this morning. We are at the highs of the morning. The Nasdaq is up 1% as the S&P rallies 0.5%, aided by the move in Nvidia this morning. 10-year yields, those move higher by 1 basis point, not enough to derail any rally. Again, aided by Nvidia. Brent crude, that moves up 1.25%, just below $89 a barrel. Let's look at some of the single name movers. With that is Nora. Good morning, Nora.
Good morning. First up, Salesforce coming out with a pretty strong growth outlook and expanding its partnership with Anthropic. The bigger message, though, Salesforce showing it can still compete as AI changes the world of software. Shares heading for their best day since 2020 and up by about 21%. Now, sticking with software, here's the other side of the AI boom. CrowdStrike seeing more demand as fears grow around AI-powered cyber attacks. The company raising its outlook for the year, with shares higher by 17%. And finally, remember all that talk about Wendy's potentially going private? Well, maybe not. A report showing that Nelson Peltz Tryon has no plans to make a takeover bid at this time. Shares of Wendy's falling down about 12% this morning. Those are your morning movers. Dani?
Nora, thank you very much. Coming up, Wall Street veteran Todd Boehly's insurer vows to restructure its $14 billion stockpile of collateral loans. We're going to get the details. That's up next. This is Bloomberg. Wall Street veteran Todd Boehly's insurer says that it will restructure its $14 billion stockpile of collateral loans after drawing scrutiny from regulators. A letter to investors showing the company is considering transactions or using other vehicles to house the assets. Joining us now is Bloomberg Chief Wall Street correspondent Sri Natarajan. Sri, I think a couple of reasons this is very interesting. One, Todd Boehly is one of the pioneers in this sort of model of having an insurer on deck in order to invest. But two, obviously, how insurers are investing are in the spotlight because of Mark Walters. What do we know about why Todd Boehly is doing some rearranging, or at least looking at where his insurer is investing?
Yes, we've been talking about this issue for the last 2-3 weeks, and ever since the news of the Lakers sale, this whole idea of the intermingling of asset managers and insurer balance sheet has been top of mind for all of us. Todd Boehly was a key lieutenant to Mark Walter until not too long ago, before he struck out on his own and has his own Eldridge Industries. But a key part of his empire is this Kansas-based insurer, Security Benefit. And the fact is, when you look at all the insurers across the country, this particular type of loan that these insurers invested in, these so-called collateral loans, Todd Boehly's Security Benefit was one of the most aggressive users of that. If you combine all the other life insurers in the country and their use of collateral loan, that probably amounts to as much as what Security Benefit was doing. There had already been pressure from insurance regulators who were trying to figure out if you needed to force such loans to hold more capital against their investments, especially if the assets backing these loans were some sort of joint venture or a private LLC, or in Eldridge's case, in Todd Boehly's case, backed by a lot of assets in Todd Boehly's business empire elsewhere outside of the insurance company. This is in response to that. Those $14 billion of loans need to be restructured. That's what the company is saying now, because otherwise they will be hit with pretty stiff capital costs if the new regulations come in place. They're racing to respond to that and reassure markets that they can address it and things will be just fine.
And so is this becoming a broader regulatory concern, this idea of private firms using the balance sheet firm insurers? Would you say that because of the Mark Walters case is becoming a bigger issue?
100%. Look, regulators will look into things when industry participants are talking about that. And if you talk to some of the large asset managers, and especially some of those who don't have their own insurers, very few of them left now, but those who don't have their own insurance company in their umbrella, they will talk about this whole idea as asset managers using insurers as piggy banks. That might be harsh, that might be unfair, but this idea that asset managers have realized that when you have an insurance company, you can make long-term investments to match those long-term assets with liabilities, and insurance money that used to be invested in sort of sleepy investments, equities, bonds, doesn't have to be that way all the time. You can find good assets, higher yielding assets, but unfortunately sometimes these tend to be riskier, and you may not have to worry with some of the biggest, most sophisticated asset managers in the world. But if this is a model that everyone up and down the chain starts to use, you have to worry about some of the lower quality players in the market and how they start to push the envelope. And is there some serious risk to your everyday policyholders then?
All you need to do is look at Apollo and the behemoth that they have become because of their insurance arm, because of Athene. And you're just talking about how it makes sense, how you have these longer term liabilities and they match up. How necessary also is it for these private capital giants to be able to use insurance money to participate things in the data center build out? The amount of money, the way the liabilities look, is it crucial for them to have these? And I wonder, to what degree does a DOJ getting more involved complicate matters for them?
It complicates to the extent that where the regulators would want discipline is making sure you're not just using the insurance channel to stuff assets that you can't distribute elsewhere. You're originating a lot of product, but if you can't really find a right place to house them, you're using the insurance balance sheet just so that you can reap the fees. That's not good. But if you're responsible about that, then maybe there is something to this model that works. And a lot of the bigger players like Apollo and Blackstone and others will tell you that this model can work. It has to be done right. It has to be done responsibly. The question is, when you pan out and look out across the financial universe, can you, with hand on heart, say everyone is doing it in a responsible way and not just as a way to use that lucrative balance sheet, that sort of ample balance sheet to find assets to fund their own empire elsewhere?
Shri, such great reporting. Thank you so much for joining us. That is Bloomberg Shri Natarajan. Coming up, it's the risk event to round out the week. Investors await Fed Chair Kevin Warsh on his next signal. We're going to go live to Jackson Hole. That's coming up next. Investors are looking to Fed Chair Kevin Warsh for clues on rates when he speaks tomorrow in Jackson Hole. Kansas City Fed President Jeff Schmid says that the Fed still has work to do. He spoke with Michael McKee.
If I'm going to be consistent, and I was a voting member last year and dissented a couple times. At the time, even the last Q3, Q4 data for me last year was, I thought we certainly weren't restrictive and maybe even a little accommodative. So we've got work to do. There's a demand element underneath all of the supply conversation that gets talked about that I just need to try to figure out, because for me, we do a lot of informal surveying around the district, and I would say it's kind of a little bit like the FOMC meetings. You've got a half of the people that say, well, it's certainly not restrictive. It seems like it might be close to about right. But for me, I think it may be accommodative on the short end.
How do you measure that?
So it's a really good question. And look, the data sets are massive, right? I mean, what you've got to do, I think, and I even have a tendency to do this, is you got to be careful about looking at, one or two prints. You really have to be thinking about the macro over the micro, because even in the district, I can get around to places, and some communities are booming, some are just doing okay. I mean, I think even about industries, the cattle industry is booming, but the poultry industry is soft. And so you really do have to be thoughtful about that, because what happens to me, and this has been my personal experience over the last 3 years, is we got it to 3, sub 3, and then it even gets harder because you don't want to overshoot with the policy rate decision. So you want some deflation down to 2, but you don't want you want deflation but not disinflation. And so that it gets harder. The decisioning gets harder. But for me, I think there's a lot of demand elements underneath this economy that I think a bit higher rate might make sense.
As soon as September 16th?
So I think for me, giving the chairman some room is important. I think these task forces are going to be instructive. I think the FOMC is looking forward, in my opinion, to those. I think there were some of my colleagues dissented at the last meeting. So I would probably put myself in that camp. But here again, there's really good arguments on both ends of this policy decision. So let's get a little bit more data. Let's see what the task forces are going to say over the next successive meetings. Maybe there's a bit of a reset that we have to make. But for me, I think we're a little on the accommodative side.
Well, if you probably can't make this official pronouncement, but would you assume, as most people do, that October 28th is off the table because it's too close to the election?
I don't think so, Mike. I think we had this discussion about independence. We get in that room. We are able to speak our truth about what we think the economy is doing. I just don't think it enters into the equation. It certainly doesn't enter into my equation. We have a mandate. It's keep prices at 2% inflation and keep employment and labor full. That's a pretty simple mandate. So I can make decisions. I can at least offer my opinion around that and be hopeful that maybe other folks on the FOMC think the same.
Does the Fed have a credibility issue? There's a lot of talk about on Wall Street that it might.
Well, for me, I just don't see it. I mean, I think if you look at the two great cycles that challenged the Fed, be it the post-08 and the post-COVID cycle, we might have missed a few things early in the 21-22 cycle, but we used policy rates to try to push inflation down. We were trending pretty well. I think we were doing our job. I think we were thoughtful in some of those moments where the labor force was structurally changing, which it still is. And so for me, I think we're doing our job. We just haven't gotten to the point where we can say, hey, we're at a good place, maybe reminiscent of kind of the cycle of the 90s, where you get inflation down to 2%, you have full employment, and then you start to use your policy rate in kind of a cycle and wave to just keep the economy moving along well.
Kansas City Fed President Jeffrey Schmid speaking with Bloomberg's Michael McKee. And Mike joins us now from Jackson Hole. Mike, it was such a great conversation, and we didn't get to it there, but there was a point when you asked him, how do you think about guiding the markets? Because this is a chair that doesn't want to guide the markets. And he had this thing where he says, I am a transmitter of information. Mike, if we don't get any clear guide from the Fed chair at Jackson Hole, in your mind, is this an FOMC? Are these committee members who are ready and willing to fill in the gaps?
Oh, absolutely. Almost all of them speak to the press on a regular basis. Lori Logan from Dallas is the one exception, although she speaks to her constituents in speeches and appearances on a regular basis. And they're not going to stop that. I've talked to a lot of members of the Open Market Committee from the bank president side, at least, and they feel like these are their constituents. These are the people that they're helping to oversee in their districts, and it's very important for them to talk to them, to let them know what the Fed is thinking and to get their thinking on the economy. So it's really not going to change a whole lot. And I think a lot gets mixed up with the words forward guidance. Forward guidance to most of these people means that they're telling you that if a certain thing happens by a certain date, we're going to do this until a certain date. And what the people on the Fed are saying is, no, we're not giving forward guidance with a date or state specific. We are giving people an if-then situation. If inflation doesn't go down, then we're going to have to probably do something, and that would likely be raising interest rates. But you notice nobody comes out and says that. They say we're going to have to take action or we're going to have to move. They're letting people know that they are on top of things without giving forward guidance. And so I think that definition is going to matter to people and to Kevin Warsh.
And we'll see what the chair himself has to say tomorrow morning. Mike, looking forward to your coverage of that. And again, tomorrow at 9 a.m., a special edition of Bloomberg Surveillance at the Jackson Hole Symposium. There will be talk with Cleveland Fed President, former Kansas City Fed Chief, and a BOE committee member.